Did we miss the opportunity? Is everything now expensive again?
It's how a lot of investors are feeling right now as the market quickly swings back towards all time highs.
There are some stocks that didn't catch that recovery.
But MarketBeat's Gabriel Ossorio-Mazzilli shares a list of 3 solid companies still trading near 52-week lows.
Buying stocks that are this cheap make all the sense in the world.
A generational buying opportunity to get into this solid dividend stock at a really bargain rate.
Up to 23% upside potential from where it trades today.
Is there still money to be made from these beaten down stocks? Let's dive in. Gabriel, so great to have you back on the show again, talking about this dip that so many investors really feel like they've missed. Stocks were down so much in April, and then we saw a really bullish May. It all happened so fast that people kind of feel like they missed an opportunity here.
This recovery from the 20% decline from all-time highs has been a record one. Usually, investors have the time to reassess, calculate, and kind of get their feelings in order and get some calculations of how much capital they want to redeploy into the market. But this time, the recovery only lasted 52 days or so. Usually, they'd have about 400 days before a 20% decline goes back near all-time highs. So everyone's just kind of dumbfounded and looking around thinking, did we miss the opportunity? Is everything now expensive again? And what do we do moving forward? And I think it's a normal reaction. But lucky for them, there are some stocks that didn't catch that recovery along with the S&P 500.
Yes, and we are going to get to your list of 3 stocks that are still near those 52-week lows and are still a good buying opportunity for investors to look at. But before we get right to your list, I want to talk about a new opportunity just for our YouTube viewers. Like Gabriel said, there's a lot of stocks right now that are going higher very quickly, and we have a list of 5 of the hottest stocks this summer that are set to soar even higher. This is a premium article, usually just for our paid subscribers. To get that report for free, and these are really interesting stocks to look at this summer. You can scan that QR code or click the link right now to get that report. All right, Gabriel, let's jump into your list of 3 stocks that are still near those 52-week lows with a lot of potential ahead. What's the first company on your list?
Right, so this one would be a not as exciting name, of course, now that everybody's focused on technology stocks. This is Old Dominion Frontline. It's one of the biggest trucking and transportation names that, like I said, wouldn't come to mind and investors wouldn't imagine thinking about it in such a bull market right now. But once again, we're not looking for the hottest stocks. We're looking for the ones that haven't gotten along with the recovery. And now this one trades at around 40 something percent of its 52-week high, right? So it's very close to its 52-week lows. That means that it's got a lot of room to move higher. The risk to reward ratio is benefiting buyers today who are looking to get into the stock. And of course, if you saw the ISM manufacturing data that came out this week, we just hit the lowest import number since 2009. So what does that tell you? We're not looking for outside logistics. We're not looking for outside supply chains. We're going to have to go inward. We're going to have to go into the United States itself and satisfy our needs, satisfy our demand with what we have on hand, what we have on inventory. But of course, that inventory needs to make its way from manufacturing hubs, from production hubs into the hands of the consumer. And I think that's where Old Dominion Frontline might come into play.
That's a really interesting stat about the lowest import number since 2009. I saw that early this week too and thought that's a really important statistic for investors to take a look at because it impacts so many industries. On the flip side of yes, the freight company is going to need to transport goods around the US, but there's going to be fewer imports to transport. Is that maybe part of the reason that this stock hasn't seen the same boost that other stocks have seen over the past few weeks?
There was no way to see the import numbers drop by this much this quickly. So I think that the fact the stock is trading this low might be because of the assumption that the coming trade tariffs were going to, slow down everything. But they didn't account for the fact that now we're going to have to look to the domestic supply chain, domestic logistics. And that might have been one of the themes that Goldman Sachs analyst Jordan Alliger saw in the stock happening now. which is why he boosted his valuation to represent up to 23% upside potential from where it trades today. Now, of course, that is attractive for a quote unquote boring stock like Old Dominion is, but still, it's very, very far from the 52-week highs yet. So I think that this one analyst might trigger other views from Wall Street, other buyers coming in, and essentially give the stock the catalyst it needs in order to regain its momentum.
Yeah, this one may be the more risky of your three picks, but the next two are really strong, solid names that have been around for a long time. Let's get to the second company on your list that was really hot pretty much all of last year.
Yeah, that name will be Chipotle Mexican Grill. I mean, who doesn't like the brand? Who doesn't like the food? While it does trade near 52-week lows, it might have been tied to increased costs on the agricultural side. It might be a worry out of the consumer sentiment being the lowest on record. But I do think that, it's not high-end dining. It's not a name that is outside of most people's budgets. So I think that again, any sort of recovery, anything that happens that's positive in the economy from now on, has a lot of room to be priced into Chipotle stock compared to what's already been priced in, which in my opinion could be the very, very worst of the scenarios right now.
Yeah, how does what's happening with Chipotle stock right now, where it's still at the near 52-week lows and hasn't risen with the rest of the market, how does that compare to other restaurant stocks, maybe similar fast casual restaurants out there?
Well, you could look at a similar competitor, right? And this is a tremendous growth name, and that is Cava Holdings, right? So Cava did see a much better price action compared to Chipotle, or you could look at another name like Shake Shack. And why did Chipotle fall behind? And then what's going on here? And I would put my finger on the fact that they're different market caps. Chipotle has gone X growth at this point. It's already gone through the proving of its market share. It's already gone through the proving of expansion. It's already gone through a lot of the stages that a younger company, a smaller company like Cava and Shake Shack are going through right now. So when you look at the financials, when you look at the margins and the business model, they're all pretty much the same. So I would say, okay, maybe we see a rotation back into the large caps. Maybe we see a rotation back into more proven names like Chipotle, which is one that's been around the block when it comes to restaurant stocks. So I think that, again, when you look at the risk to reward ratio, when you look at what's being priced in and what could be priced in as far as the upside goes, I don't think you want to go with Cava. I don't think you want to go with Shake Shack. As good a name as they may be, I think that you might want to look for safety. You might want to look for those cushions in case more volatility comes down the line while still retaining all the upside.
All right, that's a good case for Chipotle. This next one is a really good case for a company that's been around for forever and is really known as a dividend king for a lot of investors.
Right, that name would be Pepsi, and the most exciting tagline for that name, it would be the horrendous forward PE ratio that it trades at today. And I say horrendous in the best of ways because it is the lowest since the COVID-19 pandemic. So let's just go back to logic, right? Like today's world, today's economy, sure, we have tariff uncertainty, we have geopolitical risk, and we have all the negativity that's going around. But we're not in lockdowns, and the global economy is still open last time I checked. So why would a stock as safe, as stable, as big as Pepsi is trade back to the same valuations that it was back then? From there, it just doesn't make any sense. And you can, again, look at the risk to reward ratio in this name and connect it to the theme that we're looking at today. Maybe investors are looking for excitement. They're still looking for that cheap money, low interest rate days of the COVID-19 pandemic, thinking that we're still in the same market. And we're not. Interest rates are higher. Value should be in play and growth should be looked at carefully. And I think that's where that rotation that might come later might place Pepsi stock at the front of the line. And when that happens, this low valuation is going to deliver double-digit upside, not to mention the opportunity to lock in the high dividend yield that you already mentioned.
Yeah, this company has been a move to safety for a lot of investors. And that's why it's so interesting to see this stock kind of struggling like it is today. It's also interesting that comparison again, where Coca Cola actually has some momentum right now. What is the difference between these two stocks right now?
Maybe it is the supply chain exposure, maybe it is the tariffs, or just the fact that Pepsi is more diversified compared to Coca-Cola, right? When you think of Coca-Cola, you only think of the drink. You think of the soft drink without realizing that it's got a lot of other brands under it. Now, when it comes to Pepsi, you also think of snacks and you think of other items that the company operates under. But that doesn't mean that you shouldn't treat it the same as Coca-Cola. If anything, I think Pepsi has an ace up its sleeve, and that is the exposure to Celsius, right? So they support Celsius logistics chain, and by extension, they are exposed to the upside that that company is also going through today. But the valuation just doesn't make sense. And as you said, when you compare it to Coca-Cola, there should be no reason for the two names to be trading as differently as they are today. So whether it is illogical reasoning, whether it is an overreaction, whether it is people looking at a stock that goes down and to the right thinking, well, what's happened yesterday is obviously going to keep happening tomorrow. And, when the market overall thinks like that, that is exactly where you should come in and be greedy, as Warren Buffett says.
Yeah, I think that's a good concept to talk about as we wrap up this video. And some people look at this dip in Pepsi as a generational buying opportunity to get into this solid dividend stock at a really, really bargain rate. But like you said, other investors worry about picking these bottom feeders as maybe there's a reason they're struggling and there's a reason they're not picking up. What's your advice for when you're looking at getting into stocks that are closer to these 52-week lows?
Well, I would have to separate the factor of investing versus trading, right? If you do have the objective of growing your wealth over a certain amount of years and making sure that you limit your downside and increase your upside when it comes to a long-term holding period, I think that buying stocks that are this cheap, especially compared to the historical, make all the sense in the world. Now, if you're looking to trade Pepsi stock, that's where I would take a different view because a low PE multiple, a low price to book, a low anything usually means that the market sees something that doesn't make it pay for the stock. If anything, it makes it go into a discount. So if you're an investor today, you might look at Pepsi and think, if nobody's willing to pay for this stock, what do I know that nobody else does know? And in this case, you don't have to be a genius. You don't have to have a crystal ball. You just have to look around. Look at stocks like Palantir. Look at stocks like MicroStrategy. Look at Bitcoin. Obviously, everyone's focused on growth. Everyone's focused on hype. And they're leaving the boring, quote unquote, businesses behind. So in this case, it's not that you know something the market doesn't. You just understand what phase in the cycle we're in. And if that's the case, then the next phase might as well be a rotation back into safety, a rotation back into value. Now, if you're a trader, be my guest. There is a reason why the market isn't paying. Might as well go to an overvalued name that is seeing more hotter momentum because your holding period is going to be a lot shorter. But we're talking to investors here. We're talking to those who are looking to grow their wealth in the safest way possible. So this 52-week low stock that is named Pepsi, I think it fits right into today's list.
Well, some really good advice for investors and a lot to consider. Let us know what you think. Are you looking for these stocks that are trading near their lows, or are you looking for more of the momentum stocks too? We'd love to hear from you in the comments. Thank you so much for joining us, everyone. As always, happy investing.